what we do with our time, I think that is the ideal state. And that is really why investing is so important, because it allows you to do things that fulfills you, that satisfies you, and gives you a lot of confidence about whatever you are passionate about. So if you think about one's career journey, when you are initially at the beginning of your career, your human capital is at its peak. And human capital here is defined as the sum total of all the earnings that you will have in your career. And your financial capital, which is the blue line, is at the bottom. As you progress through your career, your human capital will come down because you have made some money, and your financial capital will go up because of the money that you have saved some of that money. So the idea is that if you can take the financial capital and you compound it over time, then over time you will have a much better result as far as your financial wealth is concerned. And so it is the power of compounding that we are really wanting to harness when we are looking at investing and its importance. So Albert Einstein has said that compound interest is the eighth wonder of the world. He who understands it earns it, and he who does not pays it. So it pays to then understand what is compounding. And so the formula on the right-hand side is the compound interest formula. It says that the future value is equal to amount invested times 1 plus r to the power of n, where r is the rate of compounding and n is the number of years over which you are compounding. So compound interest being a power formula, therefore, both the rate of compounding and the rate at which you are compounding and the duration over which you are compounding are very important. And so if you look at the charts here, you will see there are two line graphs. One is a solid line, which is the compound interest, and then the broken line, which is the simple interest. And you will notice that even a compound interest of 7%, which is the green line, beats a simple interest of 13%. So effectively, if you are compounding your money and even at a lower rate, you end up doing much better than a simple interest. The second thing to note here is that if the compounding goes from a 7% to a 10%, your end state where you have the total value will go up from $8,000 to $17,000. So it's almost a double if your rate of compounding increases by 3%. If it goes from 10% to 13%, then you end up with almost $40,000, right? So you can see that a small difference in the rate of compounding can have a very big difference in the end result that you get as far as the financial wealth is concerned. So rate of compounding matters. Another important thing to note is that in the first 10 years of your compounding life, you will not see a very big difference across these lines. So this is where the importance of actually thinking over long term, which is the end that we were talking about, as well as the rate of compounding matters. And now when we think about value investing, why is value investing important? Because we think that with value investing, one can compound at very good rate of return, and we can compound at for a very long period, and that will enable us to do well over time. So let's now jump into and understand what is value investing and how we can use that. So value investing has a few key concepts. The most important is the concept of margin of safety. And the margin of safety is to understand that when we are buying a company, when we are looking at buying a company which is, let's say, worth $1, we almost never want to buy it for $1. We want to buy it for a significant discount to that dollar. It could be 50 cents, 60 cents, and so on. And the reason for that is when you're buying at a discount, you have then an expectation of much higher rate of return because you're buying at a discount. The second reason is because your estimate of the value of the company could be wrong. You might think it is valued at, or it should be valued at $1, but maybe it is worth only 70 cents. So when you buy at a big discount, you have that margin where you could be wrong and still do quite well. Lastly, there are situations that happen which are completely out of the blue, and they also impact the value of your company, like a coronavirus, which is the most recent example. So because of all these factors, one needs to ensure that we are buying company at a very significant discount. I think if you look at it in real world, if you have a bridge which takes a certain amount of load, you want to have a vehicle which has much lower weight to be only allowed on that bridge. The second thing with value investing is to remember the rules that Warren Buffett has for investing. And the first rule is don't lose money. And then the second rule is don't forget rule number 1. So I think value investing is all about ensuring that you don't lose money. And to ensure that if you don't lose money, you reduce the risk and thereby you increase the return. Because by focusing on not losing money, what you have then is only the upside, and the upside will end up giving you good results over time. Lastly, as you're looking at investing, always realize that equity investing is being a part owner in a business. And just as a business owner will not worry about US-China trade war or what is happening in the short term because FBI is pulling money out, similarly, an equity investor has no reason to worry about these short-term factors. They should look at the business, and if the business is doing well, then they will do well, even if the market does not agree with them in the short term. So Warren Buffett very famously made the case for value investing, and he made the case in 1984 in a paper that he titled The Super Investors of Graham and Doddsville. There he looked at 8 of his peers whom he knew very well from many years, and he looked at how they have performed in the case, what was their portfolio performance and how did that compare to the performance of S&P, or Dow in some cases. And what you will find here is that all these investors did very well. And what was common among them was that their orientation towards value investing and what Benjamin Graham has taught to them. So therefore, he said that if most investors don't succeed, but here is a group of investors who have succeeded massively, then it can be argued that value investors work given that you have the right orientation. Now, of course, most of these investors are now the legends in investing world, and therefore one can argue that they are also very, very good, and therefore they succeed. Now, given the case that I'm making for value investing, why is it that we don't have everybody a value investor? And I think it's a very fair question to ask that. The reason people are not value investors is because value investing does not work all the time. In fact, value investing fails to keep up during the bull markets. We have been in one big, long bull market from 2009 to 2019 and also going into 20. And many of the value investors have actually significantly underperformed the indices. So therefore, it doesn't work all the time. And so people come into this approach and then they leave because it doesn't work for them. The second reason why everybody is not a value investor is because it requires a lot of patience. Most of the human beings like activity. They don't like to sit around doing nothing. And many times, as a value investor, you are waiting for the market to come back to you rather than you going around trying to get into the next opportunity. The third reason is that value investing requires a lot of work. I mean, one of the main activities is reading a lot, but also talking to other investors, talking to the company, doing a scuttlebutt on what are the competitors doing and what is the market looking like. So it is not only about reading the company, but it is also about looking at alternatives. What are the opportunities that are out there in the market, and then deciding among all those opportunities, which one is the best opportunity for you. It also requires a big amount of discipline and the emotional fortitude. Discipline to do nothing when there's nothing to do, but at the same time, having the emotional courage to buy when things have really come down and willing to sell when things look too bubbly. And I think all of us who have looked at the stock market in the year 2020 would have seen that the stock market had a very big emotional ride down and then up. So what are some of the traits of a successful investor, in this case, a value investor? I would say that one of the required traits of a successful investor is to be contrarian. Contrarian not for the sake of being contrarian, but contrarian where you feel that it is okay to stand different from the crowd, being willing to buy into things which are unpopular and selling things that are popular. Because if you buy things which are unpopular, most probably they're available at a cheap price. And if your analysis is correct and the value is significant, then you can take advantage of that. On the other hand, if the prices have gone too far up, you should absolutely look to take advantage of them and sell them. And that will happen most of the time because they're very popular. The other thing that I talked about is the emotional fortitude. So as we know that the markets have in 2020 moved from panic state, which was the case in March of 2020, to right now where many of the markets are hitting all-time peaks. So that right now it seems like the market has moved more towards the prudence to exuberance stage. So in a situation like this, the willingness to buy and willingness to not give in to the market when the market is saying everything looks doom and gloom is very, very important. So the important thing here is to understand that Mr. Market, that is what we're describing, the market is there to serve us and not to guide us. The other important trait of a value investor is to skip envy. Here I have this image and you can see that the girl has a much bigger ice cream than the boy, and boy is wondering what happened to my ice cream. But the point is, as a value investor, we don't have to worry about our returns. We need to worry about what we understand. And as long as we understand, we are under no obligation to keep up with the returns of the next person we meet. What we need to do is to have an approach that we can live with and ensure that we are continuously improving ourselves in that approach. Another one is to think like a businessman. Benjamin Graham, who is the father of investing or value investing, has said that investment is most intelligent when it is most businesslike. And if you are a businessman, you're likely to understand many of the concepts that are involved in investing. And Warren Buffett has said that I am a better investor because I'm a businessman, and I'm a better businessman because I am an investor. Another important thing which makes a big difference on whether an investor succeeds or not is the behavior and their temperament. Warren Buffett has said that the most important quality for an investor is temperament and not intellect. And this means that you need to work independently, come up with a conclusion, and then be willing to back your thesis with your actions. Benjamin Graham has said more succinctly that the investor's chief problem and even his worst enemy is likely to be himself. And why he says that is because most of the folks who invest actually get excited about investing when the markets have done well. When things are going up, they want to come into the market and take advantage of it. And similarly, when the markets have gone down, they want to get out of the market. And in both situations, if you were to get in when the markets have gone up, you will buy at an expensive price. And similarly, if you get out when the markets have fallen, you are likely to sell at a low price. And therefore, you will actually do a big harm to your portfolio by actually choosing the exact wrong time to get in and the wrong time to get out. And that is why you could possibly be your own worst enemy. So therefore, investors should introspect and assess if they have the right temperament to invest. So I will sum up the value investors and what it takes by this quote from Seth Klarman, again, one of the greats of investing. And he says that value investing requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. Few are willing and able to devote sufficient time and effort to become value investors, and only a fraction of those have the proper mindset to succeed. So some of the things that we talked about, which is required for being a successful value investor. Now let's look at some of the concepts that I have talked about value investing and how we apply these concepts at DoorDarshi. So the key ballast or the key thing that we focus on is about which I'm outlining here, is our investment approach. So we have said our investment philosophy is a value investing philosophy. So we buy with a significant margin of safety. The second thing, which is not talked about enough in the literature, is about growth. So if you look at the traditional literature, you will see that value investing is talked about more from a liquidation perspective. However, growth is a very significant part of value. And so, especially in the Indian context, most of the companies are doing well, or most of the companies that you want to invest in will have growth. And so you need to account for that growth as you're looking at value in the company. And then the other thing which we talked about is to increase the return, you have to reduce the risk by getting into companies where the probability of losses is very low. The second thing is that we have a focused portfolio. And what that means is that we want to invest more in our best ideas. We can only do that by doing enough extensive diligence initially, and then an ongoing maintenance diligence to know that we understand our positions quite well. We have a long-term orientation, and because of this long-term orientation, while in the short term returns may look volatile, over the long term the returns tend to dominate the volatility, and therefore we can do well. Also, by focusing on long term, we can reduce the noise and really come up with better decision making. We are sector and market cap agnostic, so we want to go where we can understand the companies and not to worry too much about whether it's a small cap or large cap, or we don't want to worry about specific sector. Of course, when we are investing in companies, we want to understand the ecosystem in which that company operates, and as long as we feel good about it, we are happy to invest. Another key tenet of our investment approach is to have a skin in the game with that of our clients. And this means that our investment fee varies based on our performance, and this allows to treat our investors as our partners and ensure that they are having the same sort of results as we would have, and therefore it's a strong partnership. We want to invest in companies which have good quality of business and good quality of management. And there's a famous quote which says that you can't do a good deal with a bad management. And so we want to absolutely avoid companies where we cannot trust the management. There is a question on management, and we'll come to it subsequently. We want to invest into companies which have high return on capital, right? And also which have a long runway to deliver value for us. And this will require us to find those businesses which are not easy to find, but once we find them, we want to take advantage of them. And lastly, we want to invest into companies where the management has significant ownership of the company. And so if the company does well, they will also do well. And that is, again, being a partner with managements who are in the same boat. We talked about benefiting from the manic depressive behavior of Mr. Market. And then lastly, we want to go where we feel we have a competitive advantage. And in general, we will have a competitive advantage in situations where we think our perception of the situation is different from that of the market. If we feel that our Reliance will do well, for example, and the market also feels that, then it's very unlikely that we will find a good price because market already has discounted that perception. So we want to invest into companies where we can see why others don't like it, and we can see why we like it. And that is where we will have a variant perception, and that gives us the opportunity to find good bargains. We also want to invest in areas where there is less analyst coverage. So many of the analysts are covering big companies, but when you go into smaller companies, either because of market cap or because of liquidity or many other factors, they don't have the ability to go into smaller caps, and therefore we can do well in those situations. Lastly, markets are very focused on earnings. They want to look what will be the earnings one quarter to the next, and we want to look at companies where the balance sheet is strong, where they have the ability to withstand a crisis and be able to come out stronger if the crisis were to happen. So we want to invest into companies which have the ability to succeed for the long term, and that is what we are looking for. Now, with this, let's look at what we have done so far. I think it's important not only to just talk about the concepts, but also to see what has been the consequence of what we have done. So if you look in the last 7 years, which is from September of 2013 to August of 2020, which is 7 years, our portfolio, and here the portfolio is my investment portfolio because our clients are coming at different times. We don't have a fund, we have an investment advisory model. So I am showing my own portfolio here. Over the last 7 years, the portfolio has compounded at an annualized rate of 34%. And you can, when you compare that to a small cap of 500 Sensex, everything is way below what we have done. If you now think in terms of over these 7 years, if we had invested 100 rupees in this particular portfolio, we have ended up with 782 rupees over these 7 years versus the 286 in the case of small cap and much lower in other indices. So you can see that if we compound well, and if we can compound well over the long term, I think the end result is very significantly different and much better than what you will do in other indices. The other thing to point out here is that we don't succeed every year, and success here is defined as whether we are beating the indices. I think as a value investor, we want to get absolute returns. We want to do well for ourselves because ultimately we eat absolute returns. And that is what our focus is. But if you were to look at 2019, we actually underperformed all the indices that I've listed here. But just because we underperformed in 2019 and still can come up with such good results tells you that from time to time we will underperform. But at the same time, if over the long term we can do well, I think the results can be very, very good. I also have the returns here in dollar terms because quite a few of my clients look at investing in dollars, and so they compare what they're getting in the portfolio that they're investing with us versus in other dollar forms like S&P 500. And when you talk to many of them, they will say, listen, S&P 500 has done well. If you look at it, in the last 7 years, S&P 500 has given 11.5% versus almost a 32% for the portfolio. And again, from a cumulative perspective, you can see $100 has become 700 for the portfolio versus 215 for S&P 500. So I think there is no match. But frankly, a lot of people think that because in 2019, S&P 500 did very well. It did 29%. And so they have what is called a recency bias, right? They look at what has done well recently, and they think that is what has been the result for a very long period of time. The last thing that I will point out here is that if you look at the S&P 500 and the correlation with that of the portfolio, it's only a 36% correlation. And that tells you that there is a good diversification benefit if somebody were to be invested in our portfolio as well as the S&P 500. And so when I present these results, the invariable question that I'm asked is, so, okay, the results are great. What is it that you are doing which is allowing you to succeed? And I think a few key pillars of our success. The first one is that we have a well-defined investment approach that I talked about earlier. This investment approach is then backed by an investment process that allows us to be honest and to be able to execute on our investment approach. So while investment approach can be defined as the strategy that we are following, investment process is then the implementation of that strategy. We also, as active investors, are investing in markets that we think are inefficient. We feel that Indian equity markets are inefficient because they are swayed by many non-fundamental factors. And the non-fundamental factors here are things like FPIs pulling money out of Indian markets. FPIs here means foreign portfolio investors, or you have, for example, an election coming up in one of the states, and suddenly the markets have hit a spasm, right? So there are those sort of opportunities that happen from time to time. And to the extent that we understand our companies and we are willing to take advantage of it, I think we will be able to do well. We also do well because we have a track record of success. So I talked about the track record, and that gives us the confidence to stick to our philosophy and our investment approach. We have an investor base who understands and can live with our approach. And this is important having a good investor base who can understand our approach is a critical element of our success. And I can tell you that in March, when the markets were hitting new lows, we did not even have one person or one client who we lost because of the markets or because of the portfolio performance. So they understand our approach and are able to live with it. We have a long-term orientation. One of the ways we judge ourselves is based on our performance rather than on the AUM and how big our AUM is. And so by having an investment fees that is based on the portfolio performance, we are focusing on our performance. And we want to go where we have a variant perception. I talked about the investment process. To be mindful of time, I'm going to skip it. There is a presentation that I did on my investment process around 3 years back, 2 to 3 years back, and you can take a look at that if there is an interest. I have one additional slide on evolution, on how have we evolved, but I'm going to skip this in the keeping in mind how we are doing with time, and we can come to it if there is interest. So at this point, I will stop for a few minutes, see if there are any questions on what we have talked so far. And then we can move on to the second part of the presentation, which is around the case studies. So Divyanshu, do you want to ask any questions? Are there any questions, or you want me to take the questions that you have sent across?
Yeah, so at this stage, we would like to open the platform to audience first, so that if they have any questions, we will be more than happy to take it. Or maybe even I can start with one question. So as you said, sir, in the first few slides that, the human capital decreases with age and your financial capital keeps increasing. So, but oftentimes it may happen for people, even such as yourselves, that your human capital is also correlated with financial capital, since you are in the business of investing. So then how do you take care of that correlation is my question.
That's a great question, Divyanshu. And I think you're right. See, the human capital, that particular graph, if you see, there, the calculation of human capital assumes you know what you will do with your human capital over time, right? So even though it has increased, on the first day of your career, you knew all the cash flows that you will generate from the human capital, and therefore that is already accounted for. Right.
Okay.
So basically, all you can do from that human capital is take some money away. You can never add to it, because whatever you add is already part of the initial human capital. But I understand where you are coming from. But the reason why I wanted to explain that is because that is how that graph has been created, which is to say that I know all the earnings that a human will generate in his or her lifetime.
Makes sense.
Yeah.
So I think since we don't have any raised hands, you can probably take the questions that we received from the audience before the session.
We have a few questions in the chat. I think
okay.
There are some questions pertaining to how to decide on margin of safety, a number of questions related to that. So maybe some more clarity on that concept would be really helpful.
Sure. So see, margin of safety comes from the fact that you need to first be able to assess the value of a company, right? So I think the more confidence you have in your assessment of the value of a company, the more you can be certain whether there is margin of safety or not. First point, right? So I think, as I said, I kept saying in the bullet points that you want to buy a dollar for 50 cents. I mean, that was a shortcut, right? If you think that a company is worth $1 and you can realize that dollar in the next 1 year, you would be happily buying it at 70 cents or even 80 cents, depending on your opportunity set. But if that $1 is going to become available 4 years from now, you might want like a 30 cent or a 40 cent. So your margin of safety is dependent on how long it will take for you to realize that value that you're talking about, right? How certain you are about that value. Because if you are uncertain, then you may not have any margin of safety, right? Now, this is where your assessment or your understanding of the business comes in. The better you understand the business, I think the better will be the margin of safety. And there might be also situations, a lot of people say, listen, I don't understand it, but I think this business will do all right for the next 10 years. And they don't necessarily are looking for a very significant margin of safety. But for us, we want to get good returns, and therefore we demand a lot from our investment officer. So margin of safety is all dependent on how well you understand the situation.
Okay. We have a raised hand from Mr. Prabal. So, sir, you can come online, unmute yourself, and please
Hello.
answer.
Good evening, sir. Sir, so you mentioned that we should allocate the majority of our capital to the most important bets that we believe in. But it is also advisable that we diversify our portfolio so as to reduce risk. So how can we strike a balance between these two, maximizing return and diversifying?
That's a great question. In fact, one of the slides that I skipped was around how have we evolved. And one of our evolution in investing has been that initially we would take a much more concentrated bet. Over time, what we have realized is in Indian equity markets, in general, any equity markets, but definitely in the Indian equity markets, there could be a lot of volatility, and even something which is very compelling can actually go down a lot. So what now we do is we basically would want to have our positions or our portfolio distributed across multiple positions. And one of the things how we decide how to allocate our money is what we call as expected returns. And expected return is what we think we can earn by investing in a particular situation, right? So what we do then is that we say, listen, what is it that I can expect from the various opportunity sets that I'm looking at? And then among those opportunity sets, if the returns are similar, I would want to diversify. But if the return of one particular opportunity is significantly higher than all the other opportunities, then I would want to take advantage of. So to the extent that I'm seeing a lot of opportunities, we will diversify, but we are very happy to focus on a few positions if that is what will give us good returns vis-a-vis the rest of the opportunity set that we have. So absolutely, we have to diversify, and you cannot make one position the bulk of your portfolio, or even, like for example, Warren Buffett made 40% position in American Express, right? And I think it's very hard for investors like us to be able to do that type of a concentration.
Okay, so next we have Mr. Saket. He has raised his hand, and there are two more people after that. So, Mr.
Hi, Rajeev,
Saket,
sir.
please go ahead. Yeah.
Hi, sir. Thanks a lot for today's session. I was actually looking forward to having a session from you for long, because I've been following you on Twitter as well. And thanks this platform. My query is, there was a slide, sir, which was talking about evolution of yourself as an investor, which I personally believe is very important point, because Buffett also mentioned about in his journey that earlier he was a more of a Graham type. Then he started more in looking into Fisher type of investments, and that was a journey that transformed him. And he bought Seas Candies, and so on and so forth. So his journey as a evolution. If you could share some more thoughts on this, because earlier you were doing something right, then you do something wrong, and then you realize that okay, this is not working and this is working. So would really love to have that part. Thank you so much.
Okay. So I've actually gone to that slide. I was skipping it in the interest of time, but I will quickly talk about it. So I think one of the evolution, or there are a few things that I talk about. One is that when we initially started, we were much more focused on looking at a few companies that we understand, and we would want to focus our energy on that. Over time, what we have realized is the best way to do well is to search continuously and broadly for investment opportunities. And what this does is it helps you understand what is your opportunity set. And when you're looking broadly, you are able to then look at and compare what you have versus what is out there and what makes sense. Now, the interesting problem with looking broadly and continuously is that many of the companies you will not understand. And so how do you decide whether you want to invest in a company that you understand well, but does not have as good of a forward return, versus a company that you don't understand as well, but it has good forward return? And so what we do in that dilemma is to take what we call as a starter position, a small position, right? And what gradually that helps us is it helps us understand that business. It improves our learning, our understanding about the business. And that hopefully then gives us an opportunity at some time to be able to scale into that particular position and make it a core position. So that's one. The second thing is around selling. Now, selling is something that I think most investors struggle with. We have struggled with as well. What do you do when the price runs up, right? There is an inherent momentum that is there in the stock price. It's very hard to say, I will sell, and then see whatever you liked so much, you sold because it has reached this full price and it keeps running up. So it's very hard, right? But it is what we have realized is no business in India or anywhere can go, just keep going up. But also in India, we have found that most of the businesses are very cyclical businesses. And therefore, after some time of doing well, they will turn back down. And so there is a value of selling them and taking the profits that may be there. Also, we could be wrong in our thesis, and we are frequently wrong. So when we find that we are wrong, I think there is a need to sell those positions and move on rather than come up with new reasons to hold those positions. I talked about over concentration. So we don't want to be over concentrated because we find bad things happen, right? And also, if you're over concentrated, it prevents us from rotating money from mediocre to compelling stocks if things have fallen a lot, right? And then lastly, and this is very interesting, is now we actually share our ideas with other like-minded investors. We are very happy to share our ideas where we think that we have enough to give as well as to get, right? We don't want to be only in the relationship give, right? But at the same time, if we can create a rich ecosystem of knowledge to tap in, we are very happy to do that. And similarly, that also gives us an opportunity to keep looking at new ideas. So those are some of the things that we have evolved on in the last few years.
Excellent, sir. And if time permits, I would request the host that or the co-host that possibly later I could add some more queries if time permits later.
Yeah, so can we have it later? There are two more raised hands.
Yes. Anytime. Yes.
So next we would request Ayush to unmute and ask his question.
Yes, so good evening, sir. Sir, actually, I had a doubt in my mind that you mentioned previously that you look at the companies with a strong balance sheet and not how they're performing. But sir, what all basically do you look in a company's balance sheet? Like only the fundamental analysis, or you look for something else also?
Yeah, so I think, see, balance sheet versus P&L, I think one has to first realize that balance sheet is you're looking at the stock. Balance sheet is the stock of the company, right? Balance sheet is telling you how the company has performed over the years and therefore what is the current state of the company. Profit and loss is telling you what has happened in the recent quarter or recent year, whatever P&L you are looking at. So I think balance sheet gives you a good reflection of what the company has done over multiple years, and that is what is getting reflected in the balance sheet. And so what you are there looking for is how strong is the balance sheet, right? How much debt is there? How much receivables are there? How much inventory is there? What is there? And then you can do a lot of calculations around the ratios and then see, does that make sense? What are the other companies in a similar sector doing, right? And is this even a good sector to be in, right? So I think balance sheet by itself doesn't mean much, but what balance sheet tells you is what the decisions of the management has been in the past, how the business from a sector perspective and from a company perspective looks. And that is where you start. Doesn't mean that is where you will be able to make decisions purely on the balance sheet. A lot of people talk about cash flows. I think cash flow statement is very, very important because balance sheet is useful. But if you don't associate what you're seeing on the balance sheet with what you're seeing on the cash flows, you cannot really make a decision. So when I talked about balance sheet, what I'm saying is a company's staying power depends on how strong the balance sheet is. But then that is a start, and then you need to look at many other things.
Next, Pratik, if you could unmute Pratik Amrutpur, you can ask your question.
Sure. Hello, sir. I have a question regarding Indian market. So I'd like to take a case, for example, ITC. So ITC, in my opinion, ticks all the boxes in terms of fundamentals and the strong balance sheet, good management, professional management, but still it has not been able to perform for the last 3 to 4 years. So just wanted to know, when it ticks all the boxes and you invest, then how long you should wait to hold on to this position, and what is the indicator that you think that you should exit this particular kind of a company which ticks all the boxes?
Yeah, no, that's a great question. ITC has been a dilemma. On one side, you have so many of the FMCG stocks moving, trading at peak valuation. And then here you have not necessarily FMCG, but a coming FMCG trading at reasonable valuation, right? So I think how long you wait depends on your own temperament. And I think this is where what Warren Buffett talks about, your temperament and your understanding is important. Many times you will find, for example, ITC, I think if I look at the stock, hasn't done much over the last 7 years, right? So it has almost done nothing, while the markets has gone up a lot. So, the question then is, maybe the stock price a few years back was very expensive and now it has only become reasonable. That was one way of looking at it. Another is that maybe the growth in the business has not kept pace with what the investors were expecting. And I think how long you wait, I think, is really a personal decision, right? Because you should look at putting your money into opportunities which will give you the best returns, right? So if you are saying that ITC is my best opportunity right now, you should keep it. But if you're finding other opportunities, then you should be willing to move away from ITC if you think others have a higher conviction and has a higher return. So I think it really is a personal choice. Very hard to make a generalized statement.
Right, sir. So am I allowed to counter question?
You can.
Yeah. So but when the stock is fundamentally so good, right, and it's not performing, so it goes against the grain of value investing. Like there's a saying, right, "Bhav Bhagwan che," where you identify that market knows more than what you do. So therefore, if something is really wrong with the stock, then how do you handle this kind of a dilemma then?
No, so I think that's exactly. Now you talk about ITC. ITC has not performed, as I said, and at some point people will get so tired of holding it, they will sell it. And you know what that will mean is the price might even go down further, and other people will emerge who will say, "My God, there's so much value in ITC, and let me buy it." Right? So I think what you are saying is absolutely right. That you ultimately have to accept what the market is telling you over even a long period. Right? Over a short period you can just ignore, but over a long period you have to accept what the market is saying. And I think this is where, if investors introspect and say, listen, what is it that is going on? And try to understand what the market is telling you versus what is your own assumption, I think one can learn a lot of lessons. So, for example, we did not do well in 2019, right? And I showed how we did in 2019. And I think that gave us a lot of lessons. So some of the things that we talked about in terms of evolution, some of those things came as we introspected and said, what is wrong? What is not working? And why is it not working, right? And I think with ITC, you have to introspect and say, listen, is now a good price or is it still going to keep going down, right? And what has happened in the past does not necessarily mean what will happen in the future, right? So you need to dispassionately look at ITC today, right? And say from here, what is your expectation of ITC? Yes, it has done nothing, but do you think it will do well from here? And if so, maybe you want to keep it. So rather than say, I have it in my portfolio and should I keep it or should I sell it? The question you should be saying is, if I were to look at ITC today, will I buy it? And if you don't want to buy it, then do you want to keep it is a question you should answer for yourself.
Sure. Thank you, sir.
So we'll take one last question from Sandeep Kumar and then we'll move on to the case studies.
Sure.
Good evening, sir. Sir, can you please shed some more light on what happened in 2019? I mean, all these years, the advisors has been performing quite well, and this year also it did very well compared to the other indices. But what happened in 2019? Why that such a divergence?
Yeah. So 2019, I think we all know that the equity markets have moved sort of in different ways. And I think 2019 and 2018 to an extent was year where the small caps have been beaten up black and blue, right? So for people who are in the stock markets, they know that in 2018, the stock market, the small cap stocks fell a lot, and that continued in 2019. So effectively, if you look across those 2 years, the picks that we had were basically beaten out of shape simply because that particular sector or that particular segment was out of favor. And that happens, right? And that is precisely what creates the opportunity. But as I said, the other thing that happened to us is that we were not necessarily as actively looking at other opportunities. And so we said, you know what? It has been beaten up, but now it is creating more opportunities for us. So we should be happily looking out for what else is out there and seeing if we have the best opportunities in our portfolio. Just as I was answering about ITC and saying, listen, you should look at ITC dispassionately. Similarly, we looked at our portfolio and looked at the opportunities out there dispassionately and said, what makes sense for us? And so I think 2019 was more about what was the flavor of the market. And to some extent, it was also something that allowed us to evolve and improve our processes in certain areas, like looking more broadly, talking to other people, and so on.
Got it. Sir, I think we can now move to the case studies.
Okay.
I think that will give a very good flavor to it.
Yeah, I just am mindful of, so we have spent around 45 minutes. Are we planning to extend it for another 45 minutes, or how long do you want me to cover the case studies? What's the sense?
So we don't have a hard cap as such, but I mean, as of now, we have planned for 8 p.m., but we can extend it to 8:15, 8:20, or however the session progresses.
Okay, so I will try to be go a little fast for the case studies, but happy to slow down if you guys feel that you want me to spend more time. Just so let me know about it. But I would take another 30 minutes in terms of presenting the case studies, and then we can have question and answer. Is that good?
Sure, sir. Works.
Okay, great. All right, so let's move on with the next segment of this presentation. So I think first thing to note is that I am a top-ranked analyst on SumZero. SumZero is this third-party platform where there are a lot of analysts who put their research recommendations, and then SumZero ranks them based on how those research has done over time. So they look at the performance of the research, and based on that, they will rank you. So I have been ranked in the top 5 analysts in the East and South Asia category, and that is out of 2,000 plus analysts in that particular category. And this category covers analysts across all those countries, the East and South Asia, so China, Japan, Hong Kong, India, Indonesia, Vietnam, whatever, right? So all those countries are part of this particular segment. So you will see that in this rating card, which is number 4, it also shows what are the ideas that did well for us. So the first one that did well is Manappuram Finance. Next one is KRBL. And then the third one is Infinite Computer Solutions. I'm also ranked in the top 10 analysts in the last 12 months category. So last 12 months is what are your recommendations that you have done in the last 12 months and how have they performed? So in the last 12 months, out of 20,000 plus analysts, I was in the top 10. I was ranked number 7. And there, the ideas that did well for me was Indostar, Capital Finance, KRBL, and IDFC. So those sort of a quick overview of the rankings. Now, what we will do is look at the select ideas that I had presented on SumZero, and then we will do a deep dive on some of these case studies. Okay. So I had presented on Infinite Computer Solutions in November of 2017. You're seeing a URL below when the idea was presented. And so if somebody is keen, they can go to that URL and you will see that we presented that idea and what price we presented, right? So you can actually look at the details of that idea. So it was presented in November of 2017 and the company was taken private in October of 2018. So what is interesting is we felt the company is quite cheap in November, and then promoter who was owning 75% of the company also agreed with us, and they took the company private, and we got a decent return of 75%. So we are happy. We closed the position 6 months after we presented it on SumZero. The second case study is Manappuram Finance. We presented it in September of 2018, and at that point, we again thought the company is reasonably cheap. And in October of 2019, it got to where we felt that it is fairly valued. So we closed it and we had around the 116% return on this particular idea. I am going to quickly cover the various case studies first, and then we will jump into a few, so just in case you're wondering what's going on. The third one is JM Financial. It was presented in March of 2019. And we closed it in October of 2019, and this is a negative return of 22%. And we closed this because at that point we were finding other better opportunities, which you will see subsequently. So in September, I presented a case on IIFL Finance. So far we are down 20%. The case study is still open. So this is a case study that we will cover in our deep dive subsequently. Indostar Capital Finance. So this is a case study that was presented in December. The stock gave us good returns within a few months. And so we were happy to take those returns and get out of this particular position in February. So it was a quick in and out. even though we keep saying long-term returns, sometimes the stock can move quickly. And if that happens and it meets our target, our expectations, we are happy to close that particular case study. The next one is KRBL. So KRBL was presented in April of 2020. We have so far 88% return on this position in the last five months. And it is still an open case study. So we will do a deep dive on KRBL subsequently. And lastly, I presented a case study on IDFC Limited in June of 2020. So far, and all the returns that I'm giving here is as of August 30th, right? So we will see what is the current return. But as of August 30th, it did around 69% return in the last 3 months. So that's sort of the IDFC. Now, I will, as I said, I will do a deep dive on 3 case studies, which is IIFL Finance, KRBL, and IDFC, because these are the 3 case studies that are still currently open on SumZero. All these case studies that I quickly walked you through are both available on SumZero, but they're also available on our website at DoorDarshi So you can go there as well and actually look at the case study and the write-up that we did on these case studies. Now, because I just want to have a disclaimer, because that these case studies are only for academic or illustrative purposes. They should not be construed as investment advice. Please either do your own work or consult your financial advisor before making any decisions. Don't rely on what we are saying for acting on them. Okay, so let's with that jump into IIFL Finance. So IIFL Finance, a quick background. It was carved out of restructuring of IIFL Group in 2019. It is the NBFC, a non-banking financial corporation, which is focused on retail lending. So it lends in the housing segment, gold segment, micro, small, and medium enterprise segment, and the microfinance, the loans that are given to people who don't have collateral. And they're also into the wholesale lending, which is the construction finance segment. Nirmal Jain and R. Venkatraman are the founders of IIFL Group, and they started it in 1995, and they grew it to 10,000 crores from almost zero value in 1995. Prior to the NBFC crisis, which started in 2018 after the default of ILFNS, IIFL Group had grown its business at 20% plus for 10 years. So they had grown very well, and therefore we felt that they have a potential to do well over time. Now, because of the restructuring that happened in 2019, the company was broken up. IIFL Group was broken up into 3 companies: IIFL Finance, IIFL Securities, and IIFL Wealth. So the company that we are talking about is IIFL Finance, which has a net worth currently of around 4,700 crores. Now, given the breakup of this business into 3 entities, there were many investors who had to sell IIFL Finance. And the reason they had to sell, because the market cap went down from a 10,000 plus crore group to a much smaller 3,000, 4,000 crore company. And what that did was many of the investors who have constraints either from a market cap perspective or from a liquidity perspective could not hold on to this company. So therefore, what happens is it created an interesting opportunity. Earlier, I was mentioning that whenever you're looking at an idea, also look at why the price is what it is. And so this is where if we can identify what is causing the price to be compressed, I think that makes our thesis stronger. So here are some of the facts about the company in September of 2019. When we looked at it, it was trading for around 117 rupees a share, or around 4,400 crores. If you look at from a valuation metrics perspective, price to book of around 1.2x, price to earnings 6x. It had a capital adequacy ratio, and capital adequacy is required to be able to grow your loan book. So it had a decent capital adequacy of 22%. It had a decent quality of assets with 2% GNPA and 0.8% net NPA. It had a significant insider ownership, which is Nirmal Jain and R. Venkatraman was owning around 24.5%. Fairfax, which is Prem Vatsa's group, was owning 30%. And CDC, which is a development financial institution by the UK government, was owning around 15%. So we felt good insider ownership and good marquee investors, right? So why we got interested? We got interested primarily because of the management. We have talked in the past, we like companies where we can trust the management. So we felt both Nirmal and R. Venkatraman have a fantastic track record of value creation. So we want to see that. We want to see management that has created value over time. And in this case, they had. We like the business. So we mentioned that they had delivered a 20% earnings growth for almost a decade till financial year 19. So that shows that the business had the potential. They had a good return on capital, which is a 15% return. So that is an average return, and I thought that is reasonably well for a NBFC. They were operating in credit-starved areas, right? So areas where there is a lot of latent demand, be it affordable home loan, gold loan, business loan, and microfinance. And in these areas, there was a lot of runway for growth that could happen subsequently. I mentioned about the high insider ownership and the marquee investors. The price was compelling because I talked about the valuation metrics at that point with good asset quality and good capital adequacy. And from a risk management perspective, we felt that management has done a good job of restricting the big chunky loan book, which is the developer construction loan book, and moved into more of the granular loan book. And this was getting reflected in better asset quality. So that was our thesis. What happened, as I said, we presented, and Zero took the price of 114.2 at that point. Currently, which is as of Friday, the price is 87.2. So we are down around 24% from when we presented the case study. So obviously we are down significantly. Now let's look back on the thesis, right? If you look back at what you will see here, we presented it around 114 rupees. You will notice that the stock did well initially and then had a big fall after the coronavirus crisis. So what I think, if I look back on the thesis, initially our thesis worked out well, but once the coronavirus hit, I think it dramatically impacted this thesis. The thesis was also based on the fact that the risk aversion in the system will gradually come down, which it was, right? But after the coronavirus, I think that completely changed. And because of this, there has been a much lower liquidity for non-banking financial companies, and hence they have all struggled to grow their loan book. Because of lockdown and moratorium, there is a lot of uncertainty about the quality of loan book, and investors quite rightly are focused on understanding what is the damage to this loan book, right? And therefore, they want to give it more time. One of the questions that we are asking ourselves, and it's always good to introspect, is did we do the right thing by not selling? Because you saw that from 114, it actually went way above 200 in a short period for us, and we kept owning it, right? And so one of the questions that we have for ourselves is, should we have sold, right? Because we have a thesis, we had our estimate of what a company could do. And frankly, when it went above 200, I would say that at that point, we were in two minds of whether to sell it or own it. But when you have a strong momentum in a stock, you want to ride it. So I think that was part of it. Case study is still open. We are eager to see what future brings in this particular opportunity. So we'll see how it plays out. Just a quick update on how IIFL Finance has done since. So they continue to grow the AUM book. The earnings has done well, but because they have taken a lot of one-off charges, if you look at the actual earnings that they have reported, is much lower than what is reflected in the presentation. The net interest margin, they continue to have a good net interest margin, and they continue to have good income on their assigned assets. From a return on asset, return on equity, they continue to do well, and they continue to be having sufficient capital adequacy to be able to grow the book as the liquidity comes back into the system. So what can we expect, right? There's definitely uncertainty about the quality of loan book in the short term, and I think that is to be expected. I think both the collections, right? How much are they able to collect for what is due, and how much provisions they will have to take will have a significant impact on the profitability of the company. They have already provided around 480 crores for the coronavirus related provisions, and we will see if that is sufficient. Every quarter, almost all companies say they have provided what they have to, and you will see if that is indeed true. As we go further into financial 22 and 23, we can be a little bit more confident that the business will come back, right? So this is where we can take a long-term view and actually can think whether is the business something that is permanently damaged, or is this business going to come back? And we think in this particular situation, the business will come back, but we don't know how strongly it will come back and when it will exceed its pre-COVID run rate. So we'll wait and see that, and and look at what it will translate into. Now, the important point is that the stock price has come down. So clearly the stock price is discounting the near-term uncertainty that we are seeing, right? And nobody really knows that. And so I think this particular case is a situation, I will say, where we need to be on top of what is changing and really then being willing to act accordingly. So that's sort of IIFL Finance, a quick overview. The next case study is KRBL. So KRBL was established all the way in 1889. It is India's first integrated rice company. It is present in the entire value chain, from seed development to multiplying the seeds, contact farming, production to marketing. It's in that entire value chain. It is the #1 branded rice producer in India, also the rice exporter and the rice miller. And in the last 10 years, if you look at it, they have grown revenues at 3x, earnings at 4.5x. Growth has all been achieved through internal accruals. So they have not diluted the shareholders. In fact, they did a small buyback. If you look at what the shareholders have achieved over the last 10 years, they have had almost an 8x in this particular situation. And the company has been a dividend payer every year. The important fact about KRBL is that KRBL we presented in 2 different settings. So we presented it also at the Manual of Ideas Asian Investing Summit 2020. And so this was presented before we presented it on SumZero. The slide that I have taken here is from my Manual of Ideas presentation that I did. And in fact, if anybody is interested, you can go to our website. There you will have a link to this presentation that we did for Asian Investing Summit 2020, right? And you can look at that. So when we looked at it for the Asian Investing Summit, the price was around 111 rupees. And at that price, it was selling at around 5x earnings and 4.3 times enterprise value to EBIT. High insider ownership with promoters owning 59%, right? The management has been with the company for many decades, 3 to 4 decades on an average, right? The 3 brothers, Anil Kumar Mittal, Arun Kumar Gupta, and Anup Kumar Gupta. And so why we got interested in it is it is a leading FMCG company with a dominant market share in branded rice and expanding into other FMCG products. So if you look at basmati rice market, it has a very attractive dynamics. And the dynamics are that there are many farmers who grow the paddy, and these farmers then have to sell the paddy to big millers like a KRBL or a few other competitors. So there are only a few organized players who actually take the paddy, process them, brand them, market them, and collect the money. So the supplier power is quite low here. That's the interesting bit. And also, from a competitive landscape perspective, there are only a few players. And also, basmati is only grown in 2 countries, which is India and Pakistan. And so there is a limited supply, and you're not competing with the rest of the players in the world. KRBL had a growing presence in the fast-moving consumer goods space, and they have a market-dominant brand, both in the domestic and the export markets. They have the biggest manufacturing facility. So they have a paddy processing plant where it can process 195 metric tons of paddy per hour. And they have a global distribution network. So they can process a lot of paddy and then they can distribute it to the global distribution network, both India as well as in 82 other countries. They have a fully integrated supply chain. So they actually participate in the seed development. Then they work with the farmers to grow the paddy. They procure the paddy, grade it, age it. Aging is a big part because when you age a paddy, it's and then you cook it, then the size of the rice is much better. It has better aroma, better taste. So aging is a big benefit that they add. They have big storage capability, process it, and then obviously brand and market it. They have a R&D division where they are continuously working on improving the seed quality so that it can survive the pest damage that can happen. It can survive difficult climatic conditions and so on. I talked about the management, highly respected management team, and pretty good financial performance that I talked about. So what has happened on this particular case? So we presented it on SumZero on 1st of April. We presented it in the Manual of Ideas a few days before. And what is interesting is that the stock price just moved very quickly. And so, of course, in SumZero, we had to present at a little higher price. The price right now is 278. So we have a return to date of around 85%. So looking back on the thesis, what happened is we were intimately familiar with the company, having looked at Basmati players in the past. So when Mr. Market gave us the opportunity to buy the company at a compelling price, we were eager participants in that particular opportunity. Also, a lot of branded and packaged good companies have done well, especially because of coronavirus. A lot of people are focused on health and hygiene. And so they have had good growth in the consumer packs. On the export side, they were impacted in Q1 because of the lockdown. So the ports were not available, the labor was not available, and so on. There's also an ongoing uncertainty, which is there with the company, given they have an outstanding case on the income tax department, as well as by enforcement directorate. So I will talk more about this. And then, how this case gets resolved will have an impact on how the company performs. A quick update on the company from Q1 results. So I will skip this one. Just quickly, let's look at the numbers. So I think if you look at the revenue, it is down significantly, and that is because they could not do a lot of exports. So a lot of their paddy or rice is sitting on the ports, and hopefully we will see some of that coming through in Q2. The earnings, though, has come down, but the margin has gone up. And this is interesting because in the export markets, there was a good demand, and they were able to get good margins there. Inventory has gone up some, but also what is interesting is that they were able to buy a lot of paddy in the paddy season, which is typically from October to March. That is when the paddy comes into the market. The paddy prices were low, so they were able to load up on a lot of inventory, and they have this inventory at a cheap price. So I think that inventory will come and get processed subsequently. The debt has come down. So as you can see, so KRBL, it is an interesting industry, Basmati, where you have to buy paddy during the season. And so your debt goes up when you're buying paddy, and then gradually the debt keeps coming down as you sell the paddy and bank the money. And so that has come down, and the interest coverage ratio has improved. So what can we expect here? So, as I said, Q1 was low, but management believes that revenue in 21 will be higher than in financial 20. We will see if that happens. I mentioned paddy prices fell in the season. So therefore, KRBL has the highest inventory of paddy, and this should convert into sales over the next 1 to 2 years. Now, the low prices that they procure paddy at should keep a tab over the cost of goods sold. And depending on what happens with the demand in the Middle East Asian countries, it will determine what sort of gross margin and net margin that the business will make. Over the next 4 to 5 years, management has expressed their desire to double the revenue of KRBL, and their past track record about growth gives us the comfort that there is a reasonable chance that they will continue to grow at a good pace. There is this uncertainty about income tax. So on the income tax, they have won the case in the Delhi High Court. And right now, of the more than 1,500 crores of tax demand that they have been able to bring it down to around 100 crores. And even that 100 crores, they think they don't need to pay. So they still have another case that is going on in Delhi High Court for the same. And they also have an enforcement directorate case against them, where they are possibly a party of interest around the Augusta Westland case. So we'll see how that plays out. But given the legal process, it may take a while for us to have this resolved completely. Lastly, KRBL has actually forayed into many healthy foods like quinoa, chia seeds, flax seeds. So these are all sort of healthy foods. And I think it will be interesting to watch how the company is able to associate themselves with the healthy foods and what that would mean for the margins of their existing products. So that, to some extent, will also drive how the company and the stock performs over time. Okay, now moving on to the last case study that I want to cover, and this is IDFC Limited. So IDFC, or Infrastructure Development Financial Corporation, has a rich legacy as the institution to spur infrastructure development in the country. Over time, though, it has transitioned from being an infrastructure finance company to being a holding company, and it has two main entities: 40% ownership in a bank, which is IDFC First Bank, and 100% ownership in an asset management company, which is IDFC Asset Management Company. The IDFC Asset Management Company is a mutual fund which has more than 100,000 crores of assets that they manage, both in fixed income as well as equities. It has divested all its non-retail business over the years, and we got interested in IDFC as a special situation. So this is not where we think the business will do X or Y, but we were much more interested from a special situation perspective. So let's look at some facts about IDFC. When we presented the case on SumZero, it was selling for around 17.4 rupees a share, and that is around a market cap of 2,800 crores. On the same date, 40% of the bank that it owns is worth 5,600 crores. And on the AMC side, what we did was we assumed the valuation as 3% of the asset under management. I mentioned the asset under management as around 100,000 crores, and therefore the value of the AMC as 3,000 crores. How we came up with this 3% of AUM is we looked at the various private transactions that have happened in the AMC space, and the valuation was somewhere between 3% of AUM to 10% of AUM. And so we wanted to be conservative, and we took the lower end of that valuation. So if you were to just look at the total, the sum of the parts versus the market cap, it was selling at a discount of 67% to the market value. Sunil Kakkar is the CEO, and Vaidyanathan is the CEO of IDFC, and Vaidyanathan is the CEO of IDFC First Bank. So why we got interested? We had been tracking actually Vaidyanathan for many years. We had seen what he has done in Capital First, and we were very happy of what he had done, but we could never buy it because Capital First was always very, very expensive. When we found this opportunity, we did a scenario analysis on the opportunity, and the scenario analysis was to look at the base case as well as the worst case. So in the base case, we assumed that IDFC Limited will be able to reverse merge with the IDFC First Bank, which is the biggest contributor of its value. If this were to happen, it will lead to the elimination of the holding company discount that we talked about. As I said, we valued the AMC at a 3% of AUM, and we also assumed that there will be a tax leakage of 25%, which is the corporate tax, including whatever additional taxes that you have to pay. So the total tax will come to 25%. So it was 2250 as a value for the AMC. And so the value that IDFC shareholders would get is around 7,900 if the structure were to collapse. And management has expressed its commitment to eliminating this holding company structure once the regulatory deadline of 5 years gets over. We also looked at the worst case, and in the worst case, we assumed that IDFC will not be allowed to reverse merge with the bank. Instead, the bank shares will be sold to the strategic investors globally. We assigned value only for the 25% of the bank that IDFC will be able to sell, because as per the current regulations, IDFC after 5 years will be able to bring down its holding from 40% to 15%. And so we assume that the remaining 15% that it owns in the bank is worth nothing. So that was our margin of safety in this particular situation. The AMC valuation was kept the same, and under this scenario, IDFC shareholders could get around 4,900 crores versus the 2,800 crores that the market cap was when we did the case. So even in this very extreme, where we completely ignored 15% of the value, there was a decent upside to the market valuation of IDFC. Now what happened? So we presented this case on 9th of June at a price, at that point the price was 17.4 rupees. Currently, this is as of Friday, the price is 32.2. So we are up around 85% in this particular case. And now looking back on the thesis, now obviously it looks like it was a no-brainer. Right? The risk reward was extremely favorable, even in that worst case that I talked about. There was a clear trigger event, or there is a clear trigger event, and that is 5 years after the bank came into existence, the holding company can sell from its stake from 40% down to 15%. So that trigger is going to be in October of 2020. Management has multiple times expressed their desire to eliminate this holding company discount. And Sunil Kakkar, who is the CEO of IDFC, had actually acted by selling all the non-retail business. And therefore, he has made it more palatable to reverse merge with the bank. Lastly, Business Standard had mentioned that RBI is considering allowing IDFC Bank and Bandhan Bank to reverse merge with the parent entities. So that is what was our thesis at that point. Where are we now? So IDFC First Bank valuation has gone up. It was around 14,000 crores when we presented. Today, it's around 17,000 crores. So we can obviously recalculate the sum of the parts based on the both base case and worst case. You can look at AMC value. You can either decide to adjust what we said initially, and obviously the sentiments have changed. It has improved. So one can look at and decide if you want to assign a different value to the AMC. And we believe that IDFC price, obviously not we believe, IDFC price has also improved, and therefore one can calculate how much is the discount under both the cases. And of course, the biggest unknown that we have right now is RBI stance on the holding company structure. So what they come up with, I think will have a big, will impact the IDFC price in a big manner. Now, what we can expect here, IDFC is waiting for the 5-year lock-in, which I said end of September, early October, that expires. RBI has set up a special committee. So that is something that has happened after we presented the thesis. So RBI has set up a committee to examine the holding company structure for the banks. And this committee has to submit its report by end of September. So obviously it's not yet out. And what happens to that, or what is the outcome of that report, will have a big bearing on how IDFC management decides the next course. So there is that unknown. And we do think that how IDFC valuation moves will be driven by how RBI guidelines come on this particular situation. Okay, so those are the various case studies. And now I would like to conclude my presentation by saying that, for us, having the values that we have create a lot of value for us. So we believe that associating with people who have the right values creates value for us. And one of the fundamental values that we have is that we want to partner with our investors. We don't want there is a lot of mis-selling that goes on in the financial world, but we don't want to think from that perspective. We want to partner with our investors, have a long-term orientation, and ensure from an investment perspective, we are investing in our best ideas, being contrarian, ensuring that we are not losing money, finding good businesses, good management, and most importantly, continuous learning. I think investment is an area where if you're not learning continuously, you will not be able to keep up, because what you know is never enough in this particular field. You have to continuously update yourself, understand what is happening out there, understand why you are right, also why you're wrong, and then being willing to change yourself and update your understanding of the company, update your understanding of how you approach investments. So those are all part of how you succeed and how we hope to continue to succeed. Here are my contact details. I would be happy if anybody who is either on the call or subsequently would want to have a conversation around what I've talked so far. There are many different ways of reaching out: email, phone, LinkedIn, Twitter. Somebody mentioned, Saket mentioned that he has followed me on Twitter, so that's good, or through our website. So feel free, reach out, happy to talk. I think investing, you learn a lot by talking, but we do want to ensure that it is where we are getting some value for value that we are creating for others as well. So thank you very much. Happy to take any further questions. So should I take the questions that you guys sent me, or do you have a pipeline of questions that you want me to address first?
So once again, I can start with the question. So so on KRBL, right? You mentioned that your current upside is 85.9%, and you are still holding it in your portfolio. So, sir, what do you do to resist the temptation of selling it at such a high profit? Like 86% is something that you may not get on every investment. So why do you still hold it?
Yeah, that's a good question. Why do we still hold it? I think the point is, at any given price, you have to say, what do you think what will happen from here, right? So just as I was answering the question for ITC and saying, listen, it has come down, but then you should assess what will happen from here. Okay. And I think with KRBL, we think that KRBL has potential, right? But I will not spend more time saying what is that potential, because we are not here to give investment advice. We are here to say what we are doing. And I think at any given point, what we want to do is to say, what is it that we are what is it that we are seeing? What is our investment opportunity set? And given that opportunity set, what are the areas that we think we can do the best? And that is how we make judgment on every single idea that we would have.
Yes. So we have, and I think we can allow, so Apar, I would request you to unmute and ask your question. Apar, you are not audible. Okay, no problem. So you can type in your question in the chat section and Rajiv sir can address it. Meanwhile, so Apar, while you type in the question, I think I would request Manan to unmute and ask his question. And Apar, yes, please type in your question in the chat so that we can ask it.
Hello, can you hear me?
Yes, we can.
Thank you for the opportunity, and thanks a lot, Rajiv, for a brilliant presentation. So my question is, you mentioned in the passing that when you looked at IDFC, it was sort of a no-brainer, and these kind of situations come once in a while. And we saw Warren Buffett also invest 40% in American Express when it was sort of a no-brainer to him. So I wanted to understand, how do you think about allocating or position sizing yourself in such opportunities when you think it's a no-brainer and it's related to other events rather than business, which are a lot more under control, and you have that margin of safety in the price as well. So would love to understand your thoughts on this position sizing front.
Right. No, I think that's a great question. So we definitely want to take advantage of opportunities like that by actually having a much bigger allocation to such opportunities. As you point out, we don't get these opportunities again and again. So when we find such opportunities, our percentage allocation to such opportunities will be much higher. And that is what we do. Because when we are looking at any such opportunities, as we are continuously scanning opportunities, we want to see the biggest, the opportunities that will give us the best return. And if we find those and they are head and shoulders above the rest of the opportunities, we will allocate a much bigger portion of the portfolio to it. But having said that, we are also mindful of the fact that we don't want to have too much of concentration. So we will not allocate like a 40%, as I said, that Warren does, but we do allocate a good significant chunk of our portfolio and our clients' portfolio to such opportunities.
I think Apar can now go with his question.
Yeah, hi. Am I audible?
Yes, you are.
Yeah, hi. So I just wanted to ask, so basically before entering any position, do you look at solely the value of the, basically the stock itself, or do you see index level valuations as well? So, for example, in 2017, when the small caps were overvalued, do you, would you enter a small cap at that moment? And the other question is, in your portfolio, are most of your positions basically made up of situations where, where price just converges with the intrinsic value, or are you looking for, situations where the intrinsic value. Hello?
Apar, we lost you for a moment in between. Maybe you could repeat your question.
Am I audible now?
Yes, you are audible.
Yeah, so how much of that were you able to get?
Maybe last 10-15 seconds.
Okay, so the second question was, is the portfolio made up of mostly of situations where the price converges with the intrinsic value, or are you looking for situations where the intrinsic value is growing as well for the next 5 or 10 years?
Right. So I think we are definitely very interested in both opportunities, right? If we think that there is a mispricing and therefore we get good returns because of that, we're happy to go into that. But also, if we think that a company can do well over the long term, we are very happy to own companies. There are companies in our portfolio that we have owned for almost 6-7 years and not touched it, right? And so both types of opportunities are there. And it really depends on what we think the management is capable of achieving, and what are the industries, and therefore what are the tailwinds that will determine whether we are thinking from a short-term perspective or from a very long-term perspective. But we do both. And Apar, I forgot your first question, so if you can repeat that.
Yeah, so the first question was, before entering a position, do you just look at the stock valuations? If a stock is selling at 5x earnings or 10x earnings, or do you look at index level valuations as well? So let's say if for example in 2017 was when small caps were very overvalued, would you look at small caps at that time, or is it solely basically just the stock valuation?
Right. So I think we find that looking at the markets can sometimes leave people out of investment opportunities. Right? That doesn't mean that we will never look at the markets, right? We do look at the markets. We try to enter into companies when we think we have good valuation on those companies. But to say that I will not enter because Sensex is X or small cap is Y is hard for two reasons. One, because our investors or our clients are giving us money to invest. They're not trying to tell us now is the time to invest. They're saying, listen, look at the opportunities and buy, right? And so that is one aspect. And the second thing is nobody knows. And so the fact that anybody tells you, well, the market is too highly priced and it can keep running up, as you would know, US markets have been running up, and every 2 years people will say it's too expensive and they will say, well, let's sell it. And there are so many people sitting on so much cash and they have not really participated in what has been a one hell of a bull market, right? So it's very hard to make decisions based on what our index is telling us. It is much easier to make decisions on specific ideas based on what we think the returns could be.
Right, got it. Thank you so much.
Saket, you may go next.
So thanks again. I was just writing down my query. So, sir, my query is if you're only looking at the Indian universe of companies, there are almost like 3,000 investable universe, maybe 3,000, 4,000 companies. So from those 3,000, 4,000 companies, from an individual analyst investor point of view, how do you come down to certain research universe of companies, from 3,000 to maybe 30 or 50 companies, which probably you want to research further on? So how do you, converge that 3,000 into 30 or something? Could you share more thoughts as to, is this some number screener or maybe some news or maybe some, magazines? What exactly do you do? Because that is something that I've been working, and because every day something is happening in this company, that company, in March, if you almost all the case studies that you showed was, started in March, every company was down to historical lows last 2 years. So from those companies, you jumped onto some specific companies. How did you came to those companies, sir? Please.
Right. So on the investment universe, Saket, as you're rightly saying, investment universe is very wide. How we identify areas that we want to focus on is either areas that we already understand. And so we will look at either what we own or corresponding competitors in that space. It could be where we are running screeners. It could be there is some news article which piques our interest and we say, okay, fine, this looks interesting. Let's take a quick look at it. It could be that we are having conversation with some of our friends and they are mentioning something, and that could create opportunities. It could be that we are participating in various conferences and there we are hearing some ideas, and because of that we come to know of something. So the source of ideas are varied and they can be all over, including running a screener on an ongoing basis and seeing what is interesting, right? The other thing which is interesting from finding idea perspective is you create a watch list of companies that you think are good businesses, but not good prices, right? And so what happens when you create a watch list like that is that you don't have to buy them at any point, but you basically track them and say, listen, if this were to ever come down significantly, I might have an interest. Right. Now, in terms of the case studies, I think the case studies really have 3 different time frames, right? So one is, I think, September 19, another is March or April, and then the third one is June. But in March, if you ask me specifically for March, I think in March, because the markets were so volatile, you could not actually spend a lot of time researching a new company. Either you knew a company or you did not, because everything was falling. And when everything is falling to an extent, it becomes very difficult to act. You are basically frozen, right? So either you know something at that point or you don't. And if you don't know, to build a conviction in something when something is going down every day is going to be very, very hard. So this is where preparation and knowing about companies when the things are quiet and calm is very important, so that when a situation like March comes in, you are able to take advantage.
Right, sir. A follow-up question. This was very well explained, and particularly the watch list of good businesses, but not at good prices, which are trading at. That is something that I would really think upon and work on it. Secondly, was key when you analyze any company, there are hundreds of factors. Not necessarily everything is important, but how do you? I've been looking at your slides, and there are certain analysts, investors who have 50 pages slide, 20 pages slide, or 30 pages, but your thesis explained maybe in a page or 2, which is good. Both both kind of investors have different thought process, but how do you judge what are the key pointers to focus on? Because that is something that I've been working on. Just for the sake of KRBL, you had certain pointers. In IIFL Finance, you had certain pointers about the management. Obviously in all the slides you had a lot of focus on the management, but at the same time there were different factors, but those factors could be 20 or 200 or maybe 5 even. So how do you boil it down to which are the key factors? How do you think on those parts?
Yeah, so I think see, the key factors, as you rightly point out, will vary based on the situation, right? And I think it's very difficult to say how do you boil it down. Ultimately you have to look at what is consequential. The more you find something consequential, those are the factors that you should look at, right? And the more, I personally think, and this is what Warren Buffett has said as well, which is that most of the thesis can be explained by few critical parameters. So what you need to find is those critical parameters and track them closely. And as long as you're able to do that, you will be able to do well. So I think that is the way to think, but I think it comes over time. I don't think nobody learns investing in a day. And I think the more you look at companies, the more you will have an understanding of the businesses. And therefore, the more you can pinpoint to what is consequential.
Thank you so much, sir. I would mail you if anything related to the slides if I have any queries. Thank you so much for that.
Sure.
Garima, you may go next.
Thank you. Thank you so much, Rajeev sir, for the presentation. I have a very basic question that for someone who is just new to the school and now introduced to this concept of value investing. So I understood from your presentation, especially regarding that evolution part, that you have learned through the money. The best training came from where you actually lost the money, right? So, but for someone who is new, how would you suggest that how should one train ourselves? Like, I understand there is something like play money and play money accounts, but there are books also. So is theory applicable to the real world, or how should we approach it? So could you just help us out?
Sure. I think theory is what is going to be your underpinning of how you invest. But like being a doctor, right? You learn a lot about doctor through your books, but unless you practice it, you don't really know if you are a good doctor or not. And I think it's the same with investing. You can learn as much as you want, but if you want to become a good investor, you have to start practicing. You can't say, because I have read these 1,000 books on investing, I am a good investor. You have to practice it. And that's true of it almost most of the areas in life, right? You have to practice it. You have to see what works, what doesn't. Have the humility of saying, listen, I am wrong. And have the humility of saying, why was I wrong? And then try to fix what was wrong about what you did. and through that continue to improve. So I think if you are new to the game, start with your play money, right? It's okay to lose, because initially I think the value that you will get from your education possibly will be worth much more than what you end up losing. Maybe you will maybe you will also win a lot, and that could sort of give you the war chest to be able to embark on this journey. So I think the only way really I would say is investing is first understand what are the key things. Do an introspection. I think that is very important. A lot of people don't do that. A lot of people think they are good investors because they have a brokerage account and they have some money. But if you cannot do introspection and say, why are you good? Do I have the temperament? How do I behave when the markets go down? I think those are very important things. And those will give you the indication whether you are good at this or not. And if you're not, then it is up to you to acknowledge that and decide what you do with it.
I think we have overshot by a long duration. So one last question that we'll take up. Ankit Agrawal, you wanted to ask a question? Okay, maybe Ankit has dropped off. Someone by the name e-learning. Sorry, your name is not visible, but you may go next and ask your question.
Yeah, thank you very much for giving this opportunity. And Rajeev, I'm overwhelmed with the presentation. Truly mesmerized by this whole, 68 slides. I didn't know when it got over. So there are a few questions. First is that you were tracking IIFL very, very closely. So why not IIFL that you wanted to bet on? And second question is that how do you decide what is the right price to exit? Because I mean, you entered at 117 in KRBL, and it's 85%. I am at an average price of 300. I am really wondering, is it a loss or a gain, or should I stick on? But when you are sticking on, it's giving me a motivation. So how do you decide the multiplier as to when to exit at what price point?
Right. See, on KRBL, I don't want to give you specific advice, because there are a lot of regulations around investment advice in a public forum. I'm happy to present case studies. I'm happy to talk about what I did. But I don't want to tell you anything about what to be done from here on, because that may construe as investment advice. And given the CB regulations around it, I think it's just very difficult to be on the right side of those regulations and yet do justice to your question. So I will just skip it, right? So therefore, KRBL, the one thing I will always say is don't worry about your buy price. I keep telling this. I told that in ITC as well. I told that for other people as well. What you have bought it is meaningless, right? What is important is to say, what is the current price? What I think would happen to that particular situation? And therefore, should I keep it? Should I sell it? Should I move to something else? That's completely up to you. But please don't worry about what you bought it at, because what you bought it at is not meaningful, right? Happy to hear that you enjoyed the presentation. There was one more question. Sorry, I don't remember that now.
So yeah, there was this person CA Ankit, and I think there is some problem with his connection. But yeah, he sent me his question via chat, and he wanted to ask the following: that so do you keep your money invested in a particular stock till your target price is realized, no matter how much ever upside you have gotten? In the past, I think this is related to many of your investments where you have recorded over 100% returns. So he's asking if, let's say, you have a target price in mind, do you absolutely stick in the position until you get that price, or
no? So I think when I'm presenting case studies on SumZero, you cannot say I have sold 50%, right? Or you cannot say I have sold 20%. So I don't. What I will not do is to keep the position at the same level as the price goes up, and many times the price goes up even beyond my target, because as I said, there is a momentum. So I will start selling gradually, right? But for case study purposes, it's very difficult for me to say, did I sell, did I not sell? So either you see I have sold or I have not sold, right?
Okay.
So that is what you are seeing on SumZero, but that is not what happens in the portfolio.
Fair.
Yeah.
So I guess that's it, although we really don't want this wonderful session to end, but I guess it should. So, sir, really thanks for your time. It was a Sunday morning on your end, so we really appreciate you taking out so much time for us and sharing your wonderful insights. This session was really very insightful, and especially because of the case studies, you gave us real life examples. And that's it. So these are my comments. Thanks a lot. And thanks all the participants for joining and making this session more insightful by asking questions. Thanks a lot, everyone.
Thank you so much, sir.
Enjoyed a lot. Thank you.